Good afternoon, ladies and gentlemen. My name is Johan Heidenrug, and welcome to today's webinar in the series of webinars on the impact of COVID-19 on businesses and tax. Today's webinar has been inspired by my son, who would have been married on 3rd of April. And obviously, I had to then postpone the wedding, but this process was quite traumatic because it had to deal with not only the change in dates, but also a process of communication, negotiation with numerous suppliers. It was a supplier of alcohol, which initially the wedding would have still occurred under the disaster rules, but not under the lockdown rules, but there would have been no alcohol. Then there was negotiations with the hotel, there was negotiations with airlines, whether it was postponed or not postponed, and many items came into play. For example, do we forfeit the deposit? Can you just change it? If I move the date from a Friday to a Wednesday, would the price then be reduced? And in this process, we started looking at the Consumer Protection Act and looked at the rights of the consumer and the rights of the supplier. And it was quite interesting to look at the numerous responsibilities of the parties as well as the rights of the consumer. So today is dedicated to not only the recipient, the consumer, but also the supplier of those services that have been faced with numerous challenges as they had to deal with this. But before we start, I'd also like to do a bit of a quick update on what's new before we get to the Consumer Protection Act and the impact of tax and the various impacts of events that may be on the suppliers of these consumable goods and services. So a quick update. An extract from the President's speech on Wednesday night, and it is an extremely commendable token and gesture of the President and the ministers in saying that in support of this effort, we have decided that the President, the Deputy President, ministers and Deputy Ministers will each take a third cut in their salary for the next 3 months. This portion of the salaries will be donated to the Solidarity Fund. We also said that the premiers of our country and our provinces have also joined in that they will also take a third pay cut and donate that to the Solidarity Fund. We are calling on all public officer bearers, so that will be municipalities and the like, and executives of large companies to make a similar gesture and to further increase the reach of this national effort. Now, since the executives of First Rand, Nedbank, Standard Bank, and a host of others have done the same. Obviously, being a tax person, we look at it from a tax perspective. So what does this mean? So effectively, the office bearers are entering into a salary sacrifice scheme. They are sacrificing 8.3325% of the annual salaries, but with the proviso that that portion of the cost of company will be used to make a donation by the employer to the Solidarity Fund. The 8.3325% is if you get a third less for 3 months, that equates to 8.3% of the annual salaries. And obviously, it's a call on, and the call is we are calling on executives of large companies. So it's an individual call. It's a call on an individual. It's not a call on the large companies to reduce the salaries of the executives and to donate that. It's a call on the individual to take a cut in salary and then force the company to make that payment to the Solidarity Fund or similar PBOs. Now, is it a potato? Would it make a difference? What if the President said, I am willing to take a third of my salary for the next 3 months and I will donate that out of my own pocket to the Solidarity Fund? What would then have been the situation? So clearly, last Thursday, we talked about the Section 18A and that the Solidarity Fund and similar funds would be deemed for the 3 months to be a PBO and that they'll be able to give Section 18A certificates. But that limitation is 10% of taxable income. But that 10% is an amount of taxable income. Whatever you do not use can be carried forward to following months. Now, 8.3% of gross income may actually be more than 10% of taxable income, especially if gross income includes a car allowance or certain public allowances or the like. So if they said we will contribute this amount up to 10% of taxable income, then that would have been allowed on assessment as a tax deduction, provided that a Section 18A certificate is available. But what about the PAYE? Paragraph 24F of the 4th schedule says that the amount required to be deducted from any remuneration for the PAYE purposes shall not exceed 5% of that remuneration. So for purposes of PAYE, you can reduce your PAYE up to 5% of remuneration. Now remember, that works on now a monthly event. So if the forfeiture is made in April and May and June, then it's 5% of the remuneration in that month. Now clearly that is much lower than the 33% that is actually being donated. So in essence, from a PAYE perspective, as potentially as well as upon assessment perspective, it's much better for the employee to say, I will be entitled to less of a salary, with the understanding that the employer will make an employer donation to these funds equal to that amount. Then obviously the employer will then claim a Section 18A deduction, but that also becomes quite debatable whether the employer will claim an 18A deduction or an 11A deduction, because the employer is obligated out of his arrangement with his employee to make that contribution to the Solidarity Fund. And as you would know, a donation only kicks in if there is altruistic consideration, if the company makes a contribution out of the goodness of their heart. In this case, the company is actually not making it out of the goodness of his heart, because it's out of a contractual arrangement that hopefully will be concluded with the employee. So it is opportune to just look at salary sacrifice principles. And in this case, the appeal court case of Anglo Platinum Management Services versus SARS is extremely important. So that case was heard in about 2015. So I've made a few extracts from the case that is quite interesting to have a look at. So this appeal involves a salary sacrifice scheme. Now firstly, unashamedly, in the whole case, everybody used the word salary sacrifice schemes. And for years, people tried to avoid it and said it's a salary restructure or a salary structure, but tried to avoid the terminology salary sacrifice scheme. But here, unashamedly, the terminology salary sacrifice scheme is being used. It says this appeal involves a salary sacrifice scheme whereby the appellant, Anglo Platinum, gave its employees an opportunity to participate in what it believed and still believes was a legitimate arrangement. So the scheme involved its employees sacrificing or foregoing a portion of their cash remuneration packages in return for the use of company-owned motor vehicles. Now you must say, why would they do that? Because a company car is being taxed at 3.5% or 3.25% per month. It's actually much more expensive than what it would be to lease a car. So, but this case dealt with period before the current legislation. So in that time, it was being taxed at, remember, the tax of company cars went up from 1.2% to 1.8% to 2.5%. So even at 2.5%, there was a bit of a break-even perspective, but at 1.8% still, it was much to the benefit of the employee from a overall tax perspective to receive a company car than to receive cash salary. So what happened? If the employee was entitled to, for example, a total cost to company package of 100,000 Rand, and the company will go to the employee and say, what we'll do is we'll take 10,000 Rand of your 100,000 Rand and we'll put it into a notional account. So we'll use that 10,000 Rand and we will lease a car from a financier, Westbank, Standard Bank, Nedbank, whoever. They will use it to lease a car on a full maintenance lease perspective. Over and above that, there will be insurance, but the insurance the employee will have to take over. So the company will also pay for the insurance on the vehicle. So the car will be registered in the name of the company. The car would be formally, the lease agreement will be with the company, not be the individual. The employer will be responsible for any damages and for any insurance on it. So that 10,000 Rand that you sacrifice will then be used to fund all of this. So if the cost to now lease the car and the cost to insure the car and everything is, for example, 6,000 Rand, then the extra 4,000 Rand will be paid out in the cash. If the cost will be 11,000 Rand, then the employee had to pay in the extra 1,000 Rand. Okay. So the idea was that the employee will sacrifice the 10,000 Rand. the idea was the cost of all of this would be approximately 10,000 rand. So it may be maybe 10,500 to 9,500, but he sacrifices 10,000 rand. But the tax on the company car, at that time 1.8% or 2.5%, it's not elaborated in the court case because that was not a point in contention. If that was less than 10,000 rand, if that was, for example, only 5,000 rand, then the employee would be better off from a tax perspective because he would only be taxed on 90,000 rand plus the benefit of a company car, which will, for example, be 5,000 rand, will be taxed on 95,000 rand, but his total cost to the company would have been 10,000 rand. If he received cash for it, he would have received cash for 100,000 rand and be taxed on 100,000 rand. So that's the way that the scheme actually worked. So they calculated the employee's tax on the company car, and he got taxed on 90,000 rand cash, plus the benefit of a company car, which cost the employer around about 10,000 rand. And which that 10,000 rand, as I said earlier, if less was spent, then the extra top-up would have been paid in cash, and that would have been taxed in full. If more, then the employer had to contribute. Okay. So the question was whether the scheme was valid, and was it a valid and binding salary sacrifice arrangement that gave rise to this. So the approach by SARS, so the SARS stopped relying on what happened in the special court case, but the Commissioner approaches the matter on a firmer and proper foundation that in commercial practice and the commercial world, employers and employees are entitled to structure salary packages in a tax-efficient manner. This is quite important. So the Commissioner conceded, they said, in a commercial world, as an employer-employee, you can structure your salary package as you want to. So the Commissioner contended and conceded that salary sacrifice agreements whereby employees sacrifice and forego a portion of their cash salaries in return for some quid pro quo are perfectly legal and perfectly lawful. So the Commissioner also did not contend that the scheme was a sham. Now, what's a sham? It is effectively fraud. So fraud would be, it's a disguised appearance. You are saying that that lease is an employer lease. That vehicle is an employer leased vehicle. The employer has the risk of damages and everything with it. But it's a disguised transaction. What the true intention was that it is an employee's car, that the employee is just leasing the car. And they're just putting it through the company and disguising it as a company transaction. In the context of a salary sacrifice with a donation, it would be a sham if it's a disguised employee donation disguised in a ruse to be an employer donation. Okay, so it is not a genuine transaction. But SARS didn't go, the Commissioner didn't go for that in this particular case. So he did not invoke the substance over form doctrine. Substance over form effectively is fraud. So instead, the case of the Commissioner was that the taxpayer did not achieve what they wanted to achieve. And what they wanted to achieve was a valid and binding salary sacrifice agreement. And SARS didn't like this thing where you sacrifice the 10,000 rand. If you spend less, then you get the top up. And if you spend more, you have to pay in. So SARS was saying, hang on, 10,000 rand is 10,000 rand. The commercial impact of this is that 10,000 rand is 10,000 rand. And it's not your true intention to earn 90,000 rand plus a company car. It was a true intention that you have 19,000 rand plus another 10,000 rand. But it is just, you didn't achieve this through the way that you have that top up and top down payments. Okay. So SARS was arguing that in actual fact, there was consideration for services rendered, and that 10,000 rand is taxable in full. SARS looked at a question, and the judge discussed on whether the structure was genuine. So what he said was that it is a question of fact on whether there was truly a salary sacrifice agreement. Again, unashamedly talking about salary sacrifice agreement. In this regard, a court is not concerned with what the subjective belief of the parties to the agreement, no matter how genuine this belief may be. This is important wording. So, no matter how genuine a belief is, but it is looking at those facts objectively, coldly, and establish what the result was of those facts. So, therefore, they're looking at the oral documentary evidence. So, every single time that you look at is, you've got to consider, do we need here to discuss a question of law or a question of fact? Again, this is a question of fact. The law is quite clear. If the employee was receiving cash, he should be taxed on 10,000 rand cash. If he was receiving the benefit of a company use of a company car, he would have been taxed on the fringe benefit in terms of the 7th schedule. So this is a question of fact. What is the fact, and how can you discard your onus of proof that factually there is a company car? Because the taxpayer bears the burden of proof. Okay. So to succeed in this appeal, the taxpayer, not charged, must establish on the evidence of Mr. Dolph Bridrake, who set up to this scheme, that the documents on which it relies, that there was a genuine salary sacrifice. So let us look at what those documentation was. And Anglo Platinum actually took a huge amount of effort to make sure that this scheme is properly implemented. And they looked at the policy and procedures of the motor vehicle scheme. So there's a policy document. There's a motor vehicle use agreement, which effectively said that as an employee, you can use this vehicle, but if you damage the vehicle, be responsible for that. You need to have a license. You need to, etc., need to be properly maintained and all those kind of things in order to protect the interest of the employer. They had a notional installment sale agreement, and this is interesting. Look at the word notional. So it's not a true installment sale agreement, but a notional one, and that's the one that SARS didn't really like. It was a back-to-back notional installment sale agreement. There's an annual total package allocation agreement. I normally look at it as a total cost to company benefit form. In this case, it was the AA, and then the notional account. The notional account was this 10,000 Rand that was then maintained and that kept track of all the expenses on a total company basis. So look, this is important. Paragraph 13. The employees had to complete the AA, which was this package allocation agreement, indicating how they wish their cost to company to be structured flexibly as between cash and other benefits. But this is important. This choice was available to new and to existing employees when they were offered annual increases. So it was not in the middle of the year. It was at the beginning of the year when your package was allocated. That was then provided the opportunity. So the finding in this case, to conclude, the parties sought to fund a taxable benefit from a salary sacrifice. This is a finding in appeal court. They were entitled to do so in accordance with the relevant provisions of the Act, and they achieved this through the scheme they agreed on and implemented. The following features of the scheme indicated that it was properly designed and implemented. The taxpayer purchased the motor vehicles. That was the taxpayer because of PAYE, so it was the company. Owned and claimed depreciation on them. The recovery of their total cost, including their running expenses, was obtained from the salary sacrifice, not from the employees. In return for the amount they had foregone, the employees received the taxable benefit, the use of the company car. Therefore, the Commissioner's argument that the use of the vehicle was in reality a consideration received by each employee as part of the employment and thus taxable as under gross income must fail. So the court found in favor of Anglo Platinum. Okay, so in summary, salary sacrifice schemes are legal, but the question is whether or not they've been properly implemented. A disposal of income after accrual will not result in a valid salary sacrifice agreement. If you have agreed with the employee that you've got a guaranteed package of 100,000 Rand cash per month, and it is guaranteed that the nature of that will be 100,000 Rand cash per month, then it's very difficult after accrual to then reduce that. So in order to properly implement the salary sacrifice, one will need to consider the terms and conditions of employment letters, any legislative arrangements governing salaries of officials, and all the documentary evidence that supports that. So let's look at that in the context of the President and in ministers. So their remuneration is governed by an Act, Act number 20 of 1998, which is the Remuneration of Public Officers Bearers Act. So that Act provides a framework for determining the salaries and allowances. So if you look at Section 2, it talks about the salary, allowances, and benefits of the President. It says the President shall be paid, apart from any privilege which he or she may enjoy, such salary and allowances as may be determined from time to time by resolution of the National Assembly. So if the National Assembly has decided this will be the salary, and this will be make-up of the salary, cash salary, then if they want to change that, the National Assembly must arguably change it. Okay. And now this is obviously, I've not done any detailed investigation in it, but one can't simply say, well, I'll just reduce my salary and you can pay a third of it. This is a process governed by legislation. and one needs to fill into that. So what is the process for Deputy President, Ministers and Deputy Ministers? So it's Section 4 talks about the Deputy President, Ministers and Deputy Ministers shall be entitled to such salaries and allowances as may be determined by the President from time to time by proclamation in the Gazette. So if there's a Gazette that says you are entitled to 100,000 rand, you can't simply say, well, I'll be working, I'll still be a minister, but just make it 66,000 rand. There needs to be a process. There needs to be a process. So in addition to this, now remember, this money that will be saved on the salary sacrifice can't be kept by government, just kept. It must be transferred to the disaster fund. And government can't just spend money. There needs to be a process. There needs to be approval processes for that. So obviously that money now needs to be go through approval process. Now the reality is this will never be challenged by SARS. So in reality is everybody will look at it and say it was the right gesture to do it. It will never be. But based on a purely theoretical rule, if SARS were to look at it and says, well, did you deduct the correct amount of PAYE? Was there, as enunciated in the Anglo Platinum court case, a proper structure, a salary sacrifice structure adopted? Then one will need to make sure that all these T's are crossed, that the National Assembly looked at it, but then also that truly the government now, the municipalities, in case of municipalities, that they truly make these donations, and was it then the intention? Quite interesting. So, okay. It's also interested that in Proclamation 37, it talks about the determination of salaries of deputy ministers, and they don't only talk about the salary, but also certain allowances, which is a cash amount, 120,000 rand, which is these public behavior of allowances to Section 8. You can't sacrifice that, because unless these proclamations are then withdrawn. Okay. What about the private sector? So the private sector, and it also depends on what that executive or the employee is entitled to. So it's extremely risky. In the middle of the year, we just say, well, okay, for the next 3 months, I'll get 66,000 rand, and then thereafter, I'll just get 100,000 rand again. If you have a guaranteed pocket package, if that's been guaranteed cash salary, that is what it is. You need to go through a whole process, a legal process, in order to make sure that for that period, it will not be done. Okay. So it is quite important that if the private sector, especially the private sector, also make sure that you do the salary sacrifice structure on a proper basis, and that and you can use the principles as in the Anglo Platinum case. It shouldn't be done blindly and say, well, in the spirit of it, we can just do salary sacrifices as we want to. Also be interesting, as I said before, is that if that employer is now obligated in terms of this change and this agreement, the salary sacrifice arrangement with the employee, to take that money and pay it as a donation to the Solidarity Fund, whether it will be an 11 small A deduction or whether it will be an 18 cap A deduction. And as I said previously, 18A only comes in if there's a donation. A donation you only have if you make a contribution with altruistic intent. If this is not made out of altruistic intent, it is actually made with the purpose of, because you're contractually obligated to make that payment, then it's an 11 small A deduction and not an 18A cap A deduction. Okay. A few other developments that's taken place. There's been an amendment, the days during the lockdown. So the draft disaster management relief bill talks about certain days, the days during the national lockdown. So you can see as they were drafting the legislation, they didn't say the 21 days of national lockdown. They already envisaged that it could be longer. And so that days will be regarded as dis non. Now, what does dis non mean? It means a day in which no legal business can be done or which does not count for legal purposes. So there's a whole host of things for which it will apply. Let's just go through that quickly. So firstly, this period, the 5 weeks, will not count if you are required to provide relevant material in person. So if there's an audit and SARS wants to audit and they ask you to produce certain relevant information, or if there's a request for information, if they say to you need to produce that information within 21 days, that 21 days will be the extended with the period of the lockdown. Okay. The same will apply for information for a field audit. It will also apply if there's a notice. If you're provided with notice to appear in front of an inquiry within a certain period of days, that will also then be extended automatically. Also, SARS have a warrant of search and seizure, and they must exercise that warrant within a specific period of time, or it can be extended. Then this period doesn't count for that. Through the advanced tax rulings process, if you ask for advanced tax ruling, a binding private ruling, advanced tax ruling, then, and if SARS committed themselves to respond within a certain period, then this period also doesn't count, which is unfortunate because one would have liked in certain instances to receive certain binding private rulings during this period of uncertainty. That is one area where one would have liked it to actually be accelerated and not being delayed, because one may need some advanced rulings. Okay. This is interesting. Also, this period will not count if one looks at the prescription period for tax assessments. Now, if an assessment is being assessed and you have a 3 years prescription period, for example, your ITR 14, if that is assessed through an ITR 34, then that is a SARS assessment. It's 3 years, but things like PAYE, VAT, self-assessments, and that has got a period of 5 years. So if you were forever, during the 5 year, 3 year period, you will then effectively have 3 years plus 5 weeks, and 5 years plus 5 weeks if it falls within this period. Okay. And then also applies section 100 is the finality of assessment, which links in with the prescription period. And then your chapter 9, that's all your dispute resolution process. So if you want to object against an assessment, for the purposes of this 30 business days, this period will not count. Also not for when you lodge an appeal or any other processes under chapter 9. Okay, so that is good news, but it's got a double-edged sword because it provides time for SARS and it allows time for taxpayers. So not only provides time for the taxpayers, also allows time for SARS, for example, on the prescription of tax assessments. Okay. Then, in terms of the Tax Administration Laws Amendment Act, there was a lot of uncertainty when dividend tax needs to be withheld, and it needs to be withheld at a rate lower than 20%. For example, if it was declared to a public benefit organization or was declared to a non-resident and double taxation relief, there needs to be a declaration from that recipient that they're entitled to a reduced rate. And now that declaration now, in terms of taxation laws amendment bill, needs to be in possession by the time before the dividend is paid. But that effective date is now been extended to the 1st of October 2020. The periods for purposes of the customs and excise date is also regarded as dis non, but there are also certain things that will not be regarded as dis non. But you can see there is a catch-all discretion from SARS to consider, even with retrospective effect, for purposes of the customs and excise date, whether the dates will be postponed or not. So that's a general discretion. Okay. The frequently asked document that is published by SARS also been updated. On last Thursday, there was questions about that 20% delay of employees' tax. What should be declared on the EMP 201? Should 100% be declared? Only 80%? It's been clarified. You must declare 100%, and the SARS systems will be amended so that you only pay 80% of that. The question was also asked on the RP6, on the provisional tax, because there is now obviously the first provisional is 15%. The second provisional takes you up to 65. So it's not 65. You don't pay 65% at the second. If you pay 15% on the first, then you pay 50% on the second, but you need to go up to 65 on the second. Usually you have to go up to 100%, and there was an underestimation penalty if you underestimated it by more than 20%, if you were only up to 80%. But you now only need to you calculate. But what you need to do is still declare the full amount, and then only pay to take you up to 65% at the second provisional level. Okay. So now, after we've spent the first half an hour or so on just a bit of an update, let's talk about the Consumer Protection Act and the Income Tax Act. First, before we get there, let's have a look at the scope of the CPA. So, as I said previously, when my son's wedding had to be postponed, I looked through the CPA, and I do not profess to be a specialist in the CPA, so I've just copied some of it. And from a tax perspective, looked at how this can apply to the taxpayer. So what is the scope of the CPA? It has got a very wide scope. It applies to every transaction unless it's exempted. Okay, so it's very wide, but it does not apply to provisions of goods or services to the state, but also in terms of which a consumer is a juristic person whose asset or his turnover doesn't exceed 2 million rand. Okay. The rest, if you deal with an individual, if you deal with a natural person, chances are you need to consider CPA. It is a very wide act. It applies to goods. As you would know, if you have a definition that says goods includes, it just means that it includes. It can be more than that. So it includes food, drink, alcohol, pharmaceuticals, books, e-books. It's got a very wide application of the goods to which it applies. But as you can see here, it applies also to literature, music, photograph, motion pictures, games, data, software, code, and any intangible products written. So it's quite a wide, also immovable property and the like. Okay. Service is also wide. So service includes but is not limited to any work undertaken, performed by one person for the direct and indirect benefit of another. So that's your builders, maintenance workers, doctors, accountants, engineers, website designers, lawyers, garden services, spas, nail bars. You can call it the provision of education, so your private schools, universities, banking services, banks and insurance, the transportation of an individual or any goods. So airlines, your shuttle services, bus shuttle services, railways, large bus transport, the provision of accommodation or sustenance, so your hotels and your resorts, any entertainment, so your entertainment, sports events, recordings, TV, access to electronic communication infrastructure, so your Wi-Fi, your cell phones, access to Netflix, access or right of access to an event or to any premises, so venue, hire, entertainment grounds, and then access by way of rent, so your rentals also gets covered by this. As you can see, the CPA is quite wide. So what happens if the supplier does not comply with the CPA? This is often been said is a bit of a bulldog without teeth. But there's enforcement rights by the consumer. The consumer can refer it directly to the tribunal, you can initiate complaints to the commission, and there are quite some horrendous penalties. And an administrative fine imposed in terms of this act may not exceed the greater of 10% of the respondent's annual turnover or R1 million. So it can be quite expensive not to comply with the CPA if the tribunal puts an administrative penalty on you. In addition to that, it's an offence. It's an offence in terms of this act. So the CPA is not to be played around. It is an important act, and it protects the rights of the consumer. Okay. Now, what is the relevant case? So the judgment was handed down almost a year ago, 17 April 2019. It was a special court case in the matter between a company and SARS, heard in front of the Cape Town Special Court. Okay. So what is the background? So the taxpayer carries on a business as a high street retailer of clothing, comestibles, and general merchandise. So I don't know who is the taxpayer. Typically, it would be either a Woolworths, Edgar's, or one of these retailers. So as part of the facilities offered to its customers, it sells gift cards. These can be redeemed for goods at any of the taxpayer stores. So let's assume it's an Edgar's card or it is a Woolworths gift card. You can buy it and you can go to any of the taxpayer stores, and then you can use it countrywide wherever you want to do that. It may also be a Mr. Price or any one of these. Okay. So the question in this appeal from the additional assessment by the Commissioner of the Taxpayer's Income, okay, is from the sale of the taxpayer's gift cards. Whether it's a question of timing, as soon as it was received by the taxpayer, or when it was redeemed, or if it was not redeemed, when it was expired. So this is a question of timing. Okay. So what are the amounts that were involved? The additional assessment related to the 2013 tax year, this is also relevant. So SARS issued a finalization of audit letter in 2017, and there was an amount of 140 million rand that was included in gross income. So SARS taxed the 140 million. Okay. Fortunately, SARS allowed a 24C deduction of 94 million rand against it. Okay. And then that difference of 45 odd million rand led to a tax liability of about 13 million rand. That was the topic of this court case. Okay. So the judge talked about what are we looking at? So the crisp issue for consideration is whether the monies that the taxpayer takes from its customers for the issuance of its gift cards are received within the context of gross income at the time that the issue of the card is, or when the time it's redeemed. So it's not whether it's at what stage. So it's a question of timing. But obviously, as you can see, 140 million rand is quite a lot of money. So it is it's a permanent deferral of this, because the employer, the retailer gets to hold this money. Okay. So what does the Consumer Protection Act says? Section 63(2)(b) of the CPA states that unless a longer period is determined, that card is valid for 3 years. So after 3 years, if it's not being used, then it's just prescribed. It's interesting, if you go and buy any voucher and it's valid for less than 3 years, if the issuer says to you, you need to issue it, you need to use it within the next year, let's assume it is for hairdresser or from a spa, nail bar, they say you've got to redeem it within 1 year, it's illegal, it's got to be valid for 3 years. So if they are not redeemed, then they can, then the retailer is not obliged to honor it. Okay. So, but in this case, how did the taxpayer treat the money? So remember now, you will go to a till and you'll say, I want 1,000 rand gift voucher, please. And you'll get the gift voucher and you physically hand over cash of 1,000 rand, or physically you will be paying with your credit card, or your EFT transfer, or whatever the number. At that point in time, it goes into the same till. There's one till. There's not a separate till for gift cards. There's one till, the money goes in, and it gets mingled with all the other money that the retailer has for something else. So that process. Now, what the taxpayer did is then all of this will then accrue through all the countrywide stores. And at the end of the month, they will keep track of this and say, in this whole month, there was 10 million rand, or maybe 5 million rand of gift vouchers that we sold. And we'll take this money, physically transfer it across to another bank account. Then obviously, to the extent that the cards have been redeemed, at the end of that month, they will then do a reconciliation and say, well, during this month, there was 5 million rand of cards, new cards sold. There were 4 million rand that was redeemed. So we have to take another 1 million rand and put it into this bank account. So there was at any given point in time enough money in the separate bank account equal to the face value of the gift cards in circulation and still valid. So the gift cards that have not been used and that has not been expired. Okay. So why did the taxpayer do that? And it seems that they've always done that, but it was because in the UK there was public outcry because many of these retailers actually went bankrupt, and then you paid 1,000 rand for a card, and then you want to redeem it, and then they won't give you money back. So there has been a public outcry, and for that extent, then beyond the CPA, it was common practice to transfer the money across to a separate bank account. Okay. The judge also looked at what happened previously. So this taxpayer have been selling gift cards since 2007, but up to the 2012 tax years, they just taxed themselves. Presumably, they claimed the Section 24C allowance, but then in the 2013 year, it decided, but hang on, no, I'm not going to declare this income as gross income. So they changed their practice. Okay. There was no discussion on it, but the judge just adduced that the reason for this change was because of the fact that the CPA came in around about in that time. It became effective around about that time. The judge also commented that it was correctly common ground that the sale by the taxpayer of gift cards is regulated by the pertinent provisions of the CPA. This is an important one because if you were to apply this court case, it only applies within the specific circumstances of this court case. And that is the CPA must factually apply. So there was common cause. The SARS as well as the taxpayer agreed. If all the gift cards that's there, it was issued to natural people, and it was therefore governed by the CPA, and they fall within a certain paragraph of the CPA. Okay. So what does this section 63 and 65 of the CPA reads? So section 63 talks about prepaid certificates, credits, and vouchers. Now, remember, we only talk about these gift cards. Any consideration paid by a consumer to a supplier in exchange for a prepaid certificate, card, credit, voucher, or similar device, makes it quite wide, contemplated in subsection 1 is the property of the bearer of that certificate, card, credit voucher, or similar device to the extent that the supplier has not redeemed it in exchange for goods or services or future access to goods or services. So it is deemed to be the property of the bearer of that certificate. It's quite important when you look at the wording of this, deemed to be the property of the bearer of that certificate. Okay. Now, Part 65 then is one that I'll come back to. The supplier to hold and account for consumers' property. When a supplier has possession of any prepayment, deposit, membership fee, or other money or other property belonging to or ordinarily under control of a consumer, the supplier must not treat that property as being the property of the supplier. So even though that money went into the till, that retailer is not, by virtue of Section 65, not allowed to treat the property as its property. They must treat it differently. So in the handling, safeguarding, and utilization of that property must exercise the degree of care, diligence, and skills that can reasonably be expected of a person responsible for managing any property belonging to another person. And they are liable to the owner of the property for any loss. So it is like if you park your car in my garage, it is still your car. It is deemed to be your car. The fact that it is in my garage doesn't make it my car. And I must then, in terms of this, protect your car in my garage as if it is my own. Okay, so I can't treat it as if it's my own. I can't drive around with the car as I wish. So it's effectively, this is just not a car. This is now money. But because it's money, it becomes very difficult. Because if you park your car in my garage, nobody will dispute that it's still your car. But if you park your car, if it's money, it becomes quite more difficult. Okay. So the judge went on to talk about, and this is quite interesting because it's a good analysis of the law and the way that one should read it. So obviously, the judge discussed what does the term received by mean. Okay. And it refers to many court cases that's been talking about that the money must be received for your own benefit. But it cautions that in the Geldenhuys case, it says that the question whether or not he had personally derived any benefit from it may in certain instances be a relevant consideration. So you can see it's not an exhaustive test. The question is whether it can be a test, but only in certain cases. So Geldenhuys left the route open to say that you can receive something out of which you do not receive a benefit, okay? But it is still included. You've still received it. Right, so the question of whether you've received the benefit is not an absolute rule. It is a rule. Okay. But what he says that in the context of the CPA, he believes it is a relevant case because the CPA is relevant. Okay. In its arguments, the taxpayer held two grounds. So the first ground didn't even touch the CPA. And the taxpayer said that as a matter of principle, and irrespective of the incidence of the CPA, they looked at what the factual treatment of the money was. The fact that the monies received by it in respect of the sale of gift cards are held in separate bank accounts. So the taxpayer said, hang on, I'm not keeping this money for my own benefit. I'm keeping it physically segregated. It is not applied to my taxpayer's business. I'm not using it to pay salaries. I'm not using it to buy stock. I'm not doing anything with it. If it expires, then I'll take it back. Or if it is then used, then I will take it back into my ordinary cash. Okay. And they are discretely accounted for as a liability. So effectively, you will have debit, bank, and credit, unredeemed gift card liability. Okay. So they're saying that does not make it income. Okay, until it's appropriate. Okay. So this argument is premised on the contention that the facts demonstrate that the money is not received by the taxpayer for his own benefit, but are rather held for the benefit of another, okay, which in this case would be the bearer of the gift card. Okay. The taxpayer put forward some grounds for that. So the second level of the taxpayer's argument was that it gave legal effect to Section 63 and 65 of the CPA. this taxpayer, this retailer, took its responsibilities in Section 63 and 65 very, very seriously and said, we must take this 148 million rand. We must keep it separate. We can't use it in the normal business. We must keep it separate, and we must keep a provision against it. Okay. So the court found as to the first contention. So the first contention is without thinking even of the CPA. And just says, I'm not persuaded that the mere segregation of receipts in respect of unredeemed gift cards in a separate banking account identified for that purpose gave rise to a cognizable legal context that would sustain a determination that had not been received for itself its own benefit. Okay. So the taxpayer might see itself as some sort of trustee, but ignoring for present purposes the CPA. There's no evidence that it had bound itself to a legally effective manner. So the court then rejected this first argument. And that's quite an interesting one, because many taxpayers will, in context outside the CPA, say, but I'm keeping the money separately. I'm not holding it for my own benefit. So therefore, I should not be taxed on this. And then one should look at the scope of this court case and say, but hang on, I'm probably my grounds or my contention is not that solid. Okay. Also looked at English law, and under English law, the mere segregation of money in separate bank accounts is not sufficient to establish an interest of those funds other than the account holder. Okay, so even in terms of segregation is not enough to provide that kind of protection. So let's look at what SARS argued. And this is interesting what SARS argued. Now, Ms. Williams, who acted on behalf of SARS, contended that the taxpayer's receipt in respect of the sale of gift cards were indistinguishable from any other receipts taken at its tills when the merchandise was sold. And that the revenue was available for use if it so chose. Now, firstly, I say, in terms of CPA, it couldn't choose to use it available for use. But SARS, interesting enough, they said, but hang on, the moment that you put it in that till, that 10 Rand note, that 100 Rand note, that 200 Rand note looks exactly the same as any other 10 Rand, 100 Rand. You have received it for your own benefit. And you may use that specific 10 Rand note or 100 Rand note to provide change to another customer. So that money may have been gone. So it changes its nature. So SARS looked at that point. It says at the point of receipt, SARS ignored what the taxpayer did at the end of the month. Now remember, the taxpayer at the end of the month did a net reconciliation. It said, okay, 5 million Rand of new cards sold, 4 million utilized, I'll take another million and put it into the bank account. Okay? They said that's separate. We're just looking at the moment of receipt. You need to look at the moment of receipt. She argued that it was therefore of no significance that it was subsequently transferred to identified bank account, and that the gift card receipts were intermingled at the till point, at that point. Okay. So the judge looked at the SARS contentions, and they say, so while Ms. Williams is correct that the taxpayer would, under common law, become the owner of the money paid for the gift card as soon as it changed hands, under common law, and that is commixture, and I'll get to that just now, that does not, as she sought to contend, answer the question whether the revenue generated by sale was received or accrued to the taxpayer in the relevant sense when the money was paid to it. Okay. And the judge also said that there's moreover nothing in the common law, okay, as there's also not in the English law, for someone else to temporarily into their personal account put money and then subsequently transfer it for the benefit of another party as a trust account. Okay. The difficulty is that it mixes. The difficulty is that it mixes. Okay. The judge says if the CPA was not there, he would have agreed with SARS. No doubt he would have agreed with SARS. They could have treated it exactly the same. They would have kept it separately. If the CPA was not there, he would have agreed. Okay. So that's why he rejected the argument first. But he believes that it's quite important to look at the arguments of the CPA. Okay. So the CPA is what specifically, it's deemed to be not the property of, it can't be the property of two parties. So it is deemed to be the property of the consumer. That meant the introduction of the CPA is no longer business as usual. Okay. So what SARS says is that in commixture, it mixes with all the other money, and therefore you should be looking at it. Okay. So what is commixture and confusure? So I copied there an extract from the Cambridge Law Journal. Confusio is when you mix, for example, wine. So we have a party and everybody says, okay, you bring a bottle of wine, I'll bring a bottle of wine, you bring a bottle of wine, we all mix it. It's still our wine, but at the end of the day, we each bring a liter of wine. At the end of the day, 3 liters of wine. It loses its nature, and confusio is something like wine. It loses its nature. Collectively, it doesn't become the property of anybody. It's now. And commixtio is, for example, things like money, sheep, grain, gold. So commixtio is something more solid. So in this case, it is money, it's commixtio. And what happens with commixtio is once you mix it, if you give me your wine, if I have a carafe and I put my wine in it, you put your wine in it, and everybody puts their wine in it, that money becomes actually my wine, because it's my carafe, it's whatever it's in it. In the context of money, the moment that money went into the till, because it loses its nature through commixtio, I can use that money to provide exchange to somebody else. If you pay me by credit card and that money goes into my bank account, it loses its nature. What you do have then is a right. You change it from a right to a specific item of money to a right to claim an equivalent amount of money from me. That became relevant in certain VAT cases, because you can have the same situation. You can argue that this money that is kept in a separate bank account, if I earn interest on it, how can I earn interest if it's not my money? From a VAT perspective, is it then something else? Does it become VATable because I have a bank account with not my money, so it's not a return of my investment, it's a return of some else money. But through commixtio, it actually does become my money, and that interest is still interest from that perspective, and it doesn't attract VAT. So it is a difficult one, and we can understand why it actually goes to court, and we can actually understand what the SARS contention is. And very interesting, SARS, being government, actually criticized the Consumer Protection Act. It refers to a publication by Nodea and Enslin, where they say that in many instances, the CPA is legally impossible, commercially impractical, and absurd. And I agree with that, because, for example, if you, and not necessarily in the context of a gift card, but if you, for example, pay an amount for gym fees for a year upfront. So you pay gym fees, 1,200 Rand for the year's gym fees, 100 Rand a month. And the gym uses that 1,200 Rand in order to buy the equipment that you're going to use for the next year. The whole purpose of this upfront payment is so that you can buy the equipment that you can use for a year. So it is practically impossible. Also, if you, for example, have got accommodation, you pay for the accommodation in June for your December accommodation. If they use that money in order to maintain the property and keep it up to date so that you can or they've got to do repairs to the property so that you can have access to the property in December. But the Consumer Protection Act doesn't even think about it. And that's why I often say the Consumer Protection Act practically is a bulldog without teeth, because as long as a consumer is not prejudiced, they will never go complaint to the tribunal or to the commissioner. So as long as they actually enjoy the services, so in a going concern environment, it's okay. The problem is once that resort or that hotel or that airline goes insolvent and you have paid, in terms of Consumer Protection Act, you have a right to that, and then you have a problem because that can be an offense. Okay. Fortunately, in this case, the judge took a very practical approach to it. Okay. And they looked at the practicalities of it. The judge said, but practically, you're doing this, you're putting the money into your till, you're putting the money into your normal bank account. At the end of the month, practically, you're actually complying with the Consumer Protection Act. You are doing whatever can practically be expected from you to do. So the effect of the CPA is we're looking at this effect of the CPA, and you are complying with your requirements for the CPA. Okay. So, but what about this commixture fund? So the judge considered that and said, I recognize the fact that once it's mixed with any other funds, it actually becomes yours. Because now remember, I mean, there's 148 million Rand of funds in that account. That is made up of gift vouchers varying from 100 Rand to maybe 5,000 Rand. It can't be the property of 200 million people. It is impossible that it can be on that basis. So whose property is it? So it can only be my property, and that's why the interest on that money actually accrues to the retailer. Okay, but again, the judge looked at it from a practical perspective. So he says, from a practical point of view, I see no reason why it can't be dealt with purposefully. Okay. Now, this thing, if it goes to appeal, we never know what's going to happen. It can be turned around. But it will be quite unfair because you're not allowed to use the money. Why should we be paying tax on it? Okay. That's why SARS allowed the Section 24C to be on that. And I'll go into 24C a bit later. Okay. So the judge found that it suffices to say that the tax-based method of doing so is cogently defensible. You can't really do something else. And they didn't actually even consider the status of in interest paid. Okay. So what's the finding? The finding is the income tax requires the taxpayer to include all the amounts received by it in the assessment period in the calculation of gross income. The taxpayer is legally permitted in terms of the CPA to take the receipts for itself only when the cards are redeemed and his business is ordered. Okay. And the taxpayer take that money and put it separately. So the source contended that there is a conflict between the Income Tax Act and the CPA. And the conflict was that, hang on, you've now received the money for you, and you can use it as you want to. The judge actually found that the conflict actually comes in, why should we be paying tax on something that you're not allowed to use for yourself? So the conflict is actually the contention of SARS creates a conflict between the Income Tax Act and the CPA. If the way in which this taxpayer actually dealt with it, in that we physically segregate it, we're not going to use it, and that is in line and not in conflict between the CPA and the Income Tax Act. So after having found everything, the court found in favor of the taxpayer. Okay. Now, in this case, one needs to remember, that's why I elaborated quite extensively on the court case and also the context within it was, because a lot of people say, okay, if it was covered by the CPA, then I don't have to be taxed on it. But what happens if the money was not physically segregated? Most probably, the income will have been regarded as taxable. If that retailer kept the money in its ordinary bank account and he just used it to pay salaries and everything, then it needs to be included there. And Section 24C will arguably be available, and SARS actually did allow a 95 million rand 24C allowance as this. But one needs to then consider, if you're not protecting that money as you would protect somebody else's property, are you not committing an offense in terms of the Consumer Protection Act? So the question then also comes in, if you always have a positive bank account, you always have to keep a separate bank account. And I'll argue, if you have a positive bank account, if your bank account never goes below the 148 million rand, you can still argue that you are keeping the money. You're not using it because it is always available there, but it would obviously be much safer if it is physically segregated in a separate bank account. Okay. What happens if the taxpayer just uses it for his own benefit? Okay, so that is a company that is an overdraft. My previous examples, you are a hotel, and by the way that you work, you receive monies now, and you're using it to pay for repairs and maintenance, but you just use it to pay salaries. You are an airline, you're suffering financial difficulties. You always use the receipts in advance in order to fund future. Clearly, the fact that you are actively and actually, factually using the money as if it's your own will then mean that you've illegally so, but still taxable. Because whether you're using it legally or legally, it doesn't really matter. You're illegally using that money as if it's your own. Okay. Under that scenario, Section 24C will be available because you must, you have a contract in terms of which you're contractually obligated to provide future services or goods, and therefore you must then, you'll be entitled to claim a Section 24C allowance. Okay. But you've got to consider any CPA. So within the context of a COVID-19, many companies will be experiencing cash flow problems, and they'll be tempted to be using that money for its own purposes, for cash flow purposes. Not many taxpayers will have 148 million rand to pocket in a separate bank account and leave it there, and then in its normal affairs is suffering severe liquidity problems and not paying the suppliers. And as I said before, if you use that money, it will be a contravention of the Consumer Protection Act, and that is something that one will need to consider during this COVID period where liquidity problems may be a serious effect. So As I said, then one will have to look at Section 24C. My view is that if you are either in a positive bank account situation, so you've got enough money in your existing bank account in order to pay that money because you're keeping it properly protected, or if you keep it separately segregated, and if you can argue that the amount doesn't become gross income in the first instance, then you can deduct it obviously as a from your income tax calculation, ITR 40, and you've got the case to support it. However, if you are using that money for your own purposes, or you don't have enough cash available, then you should tax yourself on the money because you have now even illegally so used the money, but then you can claim a Section 24C allowance. So it's appropriate to spend a little bit of time on Section 24C, and Interpretation Note 78 is quite a comprehensive discussion of Section 24C. Now, I need to remember that 24C is not a discretionary allowance anymore. Interpretation Note 78 was written at the time that it was discretionary, but the principles remains exactly the same. Okay, so how does Section 24C works? There must be a few requirements first. So there must be an amount included in the income of the taxpayer. So in this case, I've received an amount, prepaid income, or I've received an amount because I've sold a gift voucher. That amount must be included in terms of a contract. Okay, so there must be a contract. Now, a gift voucher is a contract. There can be a verbal or a written agreement. It doesn't really matter. In this case, you've actually got the gift card. That is a contract in itself. Okay. Now, in terms of that contract, not a different contract, that specific contract, the company is contractually obligated to fund future expenses, okay, which will be incurred. So that terminology is it will be incurred to fulfill these obligations. Shows an element of certainty. Okay, so there must be an element of certainty. I've received an amount of gift card now, and it will be incurred because the person will bring it and will buy goods from me with that. So there's an element of certainty in it. Obviously, there's always a risk that somebody just throw it away, but there must be an element of certainty. It's not an absolute certainty, it must be an element of certainty. For example, if you were an automotive and you will sell vehicles subject to a motor plan, okay, there's an element of certainty that the person will bring the car back to be serviced. Obviously, the car can be destroyed, can be stolen, so it won't be serviced, or the person might just be delinquent. So it's an element of certainty, not absolute certainty. So you'll get a 24C allowance if you provide a motor plan as part of when you sell a vehicle. But if you provide a warranty, then you do not get a Section 24C against the warranty because there's no element of certainty. It's no certainty that the gearbox will break or that the engine will fail. So there's no element of certainty. You get a 24C against the motor plan, but you do not get a 24C against a warranty. Okay. In such a manner that that expense will qualify for reduction, okay, or if it was an asset, that it will qualify for example, 11E or 12C, anything like that. Okay. So this interpretation note threw some spanners in the works because it expanded on, for example, the term of will be incurred. So let's assume you're on a factory and you have a factory and somebody gives you a prepayment for goods that you need to deliver to them. So give you R1 million of prepayment for goods to be delivered to them. The future expenses can be the future cost of the stock, anything. But if you are claiming the factory at 40-20-20-20 deductions, you can't claim the 20% or the future capital allowances under 12C if the factory is already in existence, because you've already incurred the expense. The fact that you have not already claimed the expense in full, means nothing. So if you receive a lot of prepayments, it's always better to rent a factory than to purchase a factory and claim the 40-20-20-20, because you'll never be able to get the future 11-year 12C deductions at the end of the year. So it must be incurred at a future limit. So also, if you receive the payment in advance for a stock item, that stock item is on hand, you've already incurred the cost of the stock, even though you've added it back, you've not claimed it, you've claimed the 11A deduction, added it back in terms of Section 22, but you can't get a 24C allowance on it because you've already bought the stock, you've had the stock on it. Okay, so then you get a 24C deduction. So the way in which you calculate it is not prescriptive. Generally, what one will do is on a contract-by-contract basis, say, what is my anticipated gross income? What is my anticipated future expense? That's a ratio. I'll have 90%. So you will take your income actually incurred to date, okay, multiplied by the anticipated percentage, is 90%, deduct the expenses that you've already incurred, and the balance is then Section 24C deduction. So you'll get a 24C deduction. Okay, so if you are, for example, a resort, then if you receive payments in advance for that you use and you must tax yourself on it, the 24C can deal with future salaries, it can deal with future costs for food and everything else, but you can't claim, for example, the hotel allowances on it because the hotel is already in existence. Okay. So this court case dealt with gift certificates. So let's just look at what it can potentially also apply. So if you look at it, it dealt with Section 63, and 63, as I previously talked about, it deals with a prepaid certificate, a card, a credit, a voucher, similar device. So it can apply to spa vouchers, prepaid phone cards, postage stamps, all of these things. Okay, and then it dealt with a subparagraph 3, 63.3, that says any consideration paid by consumer to supply in exchange for a prepaid certificate, card, credit, voucher, similar device, okay, is deemed to be the property of the bearer of that certificate. Okay, so that's where the court case. But it's not just a gift card; it can also be spa vouchers, also be your postage stamps, etc. Okay, now that's easier. But let's look at 64. So that's prepaid services and access to service facilities. So 64 says, if in terms of an agreement, a consumer agrees or is required to pay a one-time or periodic membership fee or similar charge. So what can that be? So that is, for example, your annual gym fees. You pay upfront for a year's gym fees and at Virgin Active or whatever, and that applies to it. It can apply to your McAfee antivirus software. It can apply to SABC, DSTV, or anything like that. So that can apply. So 64 also applies to that. Or any amount in respect of services or access to services to provide it at a date more than 25 business days after the payment is made, other than by way of a prepayment device. So if you've got a prepayment device in 63, so a gift card, then it's covered by the gift card. So in this case, let's assume you're in December and you pay for a flight to occur in March. That money is still deemed to be yours. Okay, and then the question comes in, until when? All right, so this is quite wide. So, and it only applies if the service is more than 25 days. So if it's more than 25 business days, so if at the end of February I book a hotel in March, then immediately that doesn't apply. Immediately becomes, even though the taxpayer may then keep it until the day that I rock up for the event, for that 25 business day, before that 25 days, then it is still deemed to be my money. Okay, so flights, accommodation, wedding planner, everything like that. Okay. So then subparagraph 2 takes, a supplier may make a charge against the consumer's money contemplated in section 1 once each month in advance for the pro rata portion of the amount so held as required to pay for the ensuing cost of membership or service. Okay, so on the 1st of March, you can then make a charge for the flights or the accommodation or the gym fees or anything for the services in March. Okay, so that you can then do, right? And then let's look at what the impact of that is. You can see then the wording is almost the same, but it doesn't have a subparagraph for it. 64.1 says the amount so paid remains the property of the consumer until the supplier makes a charge against it in accordance with subsection 2. Okay. Now there's a difference because 64.1 says it remains the property of the consumer until the supplier actually makes a charge against it. 2 says you may make a charge. So it remains your property until you factually make a charge. Many suppliers will only factually make a charge, for example, for flights or for accommodation, when on the date of the flight, when the person is there for the flight or the person actually arrives for the accommodation. You're entitled to make a charge earlier, okay, but it remains a property until you factually make that charge. So if it's in the month, it doesn't really matter from an income tax perspective, because whether you may make a charge on the 1st of March and then the actual charges come through, the actual supplies come through in March or not, it doesn't really matter. Okay, so it's a question when you may make a charge. So this is much more difficult to apply Section 64 in the context of Income Tax Act than 63, because on 63 it was quite clear. In the 63.3, you remain the property until it is applied, until it gets forfeited after 3 years. This one is you may make a charge against it. Okay, but still the same thing applies. The amount so paid remains the property of the consumer until the supplier makes a charge against it in accordance with subsection 2. So some of it may be very, very clear. Okay. Now, as I said, it can apply to flights, accommodation, it can apply to a wedding planner, it can apply to any advance kind of payment that you are doing. Right, and there's the 65 obligations. As I said previously, you must keep it in such a manner that it will be upheld. Okay. So to conclude up to this point, when you look at it from an accounting perspective and you want to do the tax return of a company, the second category, for example, your airlines, your accommodation, anything that's dealt with under Section 64 would be much more difficult, because you've got to then split out which portion of these advance payments are for periods more than 25 days, which portion is for periods less than 25 days. You can't simply say, well, because most entities will just keep it. They say, I've received it and I keep a provision against it. You can't just say that provision that I have is not taxable by virtue of the Consumer Protection Act. To the extent that that provision has been received for advances more than 25 business days before, yes, then you can do the CPA, but only then if you kept that, you've complied with your requirements in terms of 65. So you've protected it, either in a separate bank account or you're in a positive bank account. But so if you want to use this requirement to reduce the tax incidence on a taxpayer, you do need to split it out. You need to say, if I've received a payment in advance, did I receive it more than 25 business days or less than 25 business days? If it's less than 25 days, the Consumer Protection Act doesn't, that is not deemed to be the property of the holder. It is still yours. Okay. So there's a big difference between a deposit and a part payment, and more from a VAT perspective. Both, remember, the Section 64 also deals with deposits. So whether it's a deposit or part payment, it doesn't really matter, because both are treated in terms of Consumer Protection Act. Okay. So deposit is defined in a number of places in VAT guides. So the first you find is the guide for motor dealers, and it says that a deposit acts as a security for delivery of future goods. Now, deposit is specifically excluded from the definition of a consideration, and therefore it's only when you forfeit it, that it becomes the subject to VAT. In the VAT Guide 411 to entertainment, accommodation, catering, they also talk about the deposit, and it talks about a deposit, again, is made to secure future delivery of goods. This guide actually goes further on, and it tries to talk about a deposit that sometimes you clear in as a deposit, but it may not be a deposit, may actually be a part payment. So the guide says, but if the deposit is in fact part payment for the supply of the accommodation in the first instance, and not a security deposit, the time of supply for accommodation will be triggered under the general time of supply rules as discussed in 7.2.1, and a tax invoice must be issued within 21 days. Okay? In many cases, these so-called deposit payments, which accommodation establishments require confirmed booking, are really prepayments of consideration for the supply of commercial accommodation. The liability to account for VAT in these cases will be triggered, okay, at the time that any invoice is issued, or the full or part payment of the consideration. Okay, so from a VAT perspective, let's assume the full consideration will be R1,000, and you get a part payment of 100. You must still be liable for the VAT on the 1,000, okay, because that is the full amount is triggered, okay, or when you issue an invoice for it, Okay, so be very careful about time supply on that. And what SARS also alluded to in the VAT 411 guide is that your document may in fact be invoice. Remember, invoice is a document indicating an obligation to make payment. Okay, so they're saying that the document that you send out requesting of a deposit can't be an invoice. It can be a separate document that you say in terms of a policy you're required to make a deposit of 1,000 Rand by this date. Okay, then you must deal with that deposit. Right. So the VAT guide talks about that there can be a difference between a prepayment and a deposit, even if you try to color it in as a deposit, and you must look at the documentation associated with that. Right. What happens on cancellations? So, and how does the CPA deals with cancellations of bookings? Okay. Section 17 deals with the consumer's right to cancel advance reservation bookings of order. And it says that a supplier who makes a commitment to accept a reservation to supply goods or services may require payment of a reasonable deposit in advance. Now, remember that deposit, if it's more than 25 days, then it is still deemed to be property, and impose a reasonable charge for the cancellation of the order reservation. So that obviously, as we were cancelling the wedding, then there was consideration: are you going to lose your deposit, or are you not going to lose your deposit? That can only be reasonable. Okay. Subparagraph 5 says a supplier may not impose a cancellation fee in respect of a booking reservation order if the consumer is unable to honor the booking reservation order because of the death or hospitalization of the party for whom or for whose benefit the booking was made. So if you're in hospital, if you have to go, if you booked a honeymoon but then you fall ill and you cancel it, if it's due to your hospitalization, then the supplier cannot charge a cancellation fee. It's unfortunate because it's not only, as you can see, it's not only tax laws and UIF and your employment tax incentive legislation that's got to be changed to COVID-19, but things like Consumer Protection Act should also be changed and amended in line with the COVID-19, because the consumer is also going to be protected against unfair treatments by suppliers, but also the suppliers must also be protected. Okay. So what is a reasonable charge? In our case, there was an extension of the booking, but it was extended from a Friday to a Wednesday. And part of the deal was that the price won't be reduced. Normally, a Wednesday is cheaper than a Friday, but then they asked the same price. But it's unfortunate that one couldn't do much about it. Okay. So what happens if there is a cancellation fee from the perspective of the supplier, of the taxpayer? Obviously, as that cancellation fee comes in, then that will become gross income, and that cancellation fee will then also attract VAT. Okay. So other sections in the CPA, your right to cooling off period. So does that impact income tax? So it says the consumer may rescind a transaction resulting from direct marketing without reason or penalty within 15 days. Okay. So that's from direct marketing. From an income tax perspective, the transaction has happened. The transaction is then just subsequently cancelled, so the gross income accrues. You can also not claim a Section 24C allowance on the probability that people may bring back the goods because there's no element of certainty of it. Be careful if your client is applying IFRS. IFRS 15 often requires a revenue recognition because of this right of the consumer to bring goods back, and they may recognize the income only after a period of time. Okay. From a tax perspective, from VAT perspective, you need to issue a tax invoice originally, and if the goods are brought back, then you can and must issue a credit note. You must issue the credit note because it's only upon that credit note that you can actually claim an input tax deduction. The consumer also has the right to return goods within 10 business days. Now, again, from an income tax perspective, you have full income. You can't get 24C because you know that there is no obligation on them to return it. There's no element of certainty to it. And again, IFRS 15, with the adoption of IFRS 15, that returns often take into account in the revenue recognition to say that I'm a big retailer. If customers are bringing back regularly goods within 10 business days, I regularly have to reverse this sale then you may decide to not recognize a portion of your revenue. Then obviously for income tax purposes, in your tax return, your ITR 40, you've got to make an adjustment for that. Again, from a VAT perspective, you must issue a tax invoice, a credit note when it gets returned, and based on the credit note, input tax deduction can be claimed. Okay. Customer loyalty programs. Now, obviously, a customer loyalty program that you just provide points to customers, and they can use it in order to get discounts on future goods. There's no real event, there's no tax deduction, nothing at that point. And then from a VAT perspective, as they apply the loyalty points, they'll just have a lower amount of an output VAT. But be careful, there are numerous schemes of loyalty points that are run by external parties. So if a company gives loyalty points away and then make a physical payment of cash to a third party, that physical payment of cash may or may not qualify for tax deduction, and it may or may not be spread in terms of 23H, because if you have a loyalty program and you pay somebody else in order to take it over, do you enjoy the benefit of it over a period, or is it only or is it immediate? And also the VAT consequences of that need to be considered. And then in the recipient company, there are many of these loyalty companies that runs loyalty program. As they receive the income, they'll probably be entitled to claim a Section 24C allowance. They'll be taxed immediately. Claim a 24C as they are honoring their members' obligations under the loyalty program. So it can be quite complex, and especially on the VAT perspective, there's also a number of interesting binding rulings out on loyalty programs from a VAT perspective. Okay. Lay-bys. From an income tax perspective, the same rules as under the court case should apply, because that property is regarded to be the property, it remains the property of the consumer until the goods are delivered. So again, the same rules should apply, but if you're using it as if it's your own, again, tax it, claim 24C allowance. From a VAT perspective, there are specific rules in the VAT 404 guide. Looked at paragraph 5.2.7. It's generally the VAT only takes into account once the deposit is applied, once the goods are delivered. Returnable containers. Again, one needs to look at it carefully from an income tax perspective. If you are selling cold drinks in bottles and you need to, the whole amount accrues to you, there's no obligation on that person to bring back that bottle, and so you can't claim a 24C allowance against it. People can bring back bottles to you that are sold from a totally different party, so you are not incurring a cost because of that contract of sale. So there's no 24C allowance that you can claim. Okay, and it's all taxable. Okay, so once you do pay it, you can claim an income tax deduction. If you do provide that bottle from a VAT perspective, then obviously you're buying second-hand goods and you need to comply with the second-hand goods to claim a notional input tax, unless the supplier is a VAT vendor for returnable containers, pallets, or things like that. So look at, there was interesting discussion on when the VAT rate increased from 14% to 15%. I've quoted this in this document under frequently asked questions, and it's quite interesting how the VAT Act also works with returnable containers. Okay. The retailer is going to be faced with increased levels of doubtful debts, so it's appropriate to have a look at Section 11J. Now, 11J has been amended. Originally, up before 2018, there was only one 11J. Then 11JA was brought into account, and that applies to your banks with effect from 1 January 2018. So a bank is a covered person. So if you're a covered person, and if it's a year of assessment commencing on or after 1 January 2018, then you apply the new 11JA. I'm not going to talk about that. If it's before that date, then you apply the old 11J, and there was the Basel ruling for banks. Okay. If the taxpayer is not a covered person, if it is for years of assessment commencing on or after 1 January 2019, you apply the new 11J as amended in the 2018 Taxation Laws Amendment Act. If it was before that, you apply the old one. Okay, so today I'm just briefly going to touch on the new legislation, and at the center of the new legislation is whether or not the taxpayer is applying IFRS 9. So let's just look at IFRS 9, and it's appropriate to look at IFRS 9 now, because this COVID-19 really places an IFRS 9 obligation on large companies. So The criticism against the old IAS 39 was that it waited for an event to happen before you started providing against, for counting purposes, for doubtful debts. And the argument was that it's too late. Because if you run a business, on the day that you do the transaction, you know for a fact, historically, that, for example, 5% of that will be doubtful bad. So IFRS 9 accelerates the doubtful debt allowance provision, the impairment of your debts. It accelerates it to the date of initial recognition. It says that today, I'm Eskom and I am selling electricity to municipalities. I know that 10% of that amount I'm never going to get. So you already provide, even though there's no delinquency, there's no non-payment, there's been no follow-up, even at that point, at initial recognition, you need to make a impairment amount. That is phase 1. So that's a stage 1 impairment. And that is made for a 12-month expected credit loss. Okay. Under stage 2, if the credit risk increases significantly, it's not considered low. Then you move from a 12-month expected credit loss to a full-time expected credit losses. Okay. So even now, with the COVID-19, and you know that businesses are not operating for 5 weeks, you know that in certain industries it can be longer. If your industry is a transport companies, if your industry is entertainment, it's probably that they're not going to have venue hires for people more than 100 for a period in time. So that fact increases the credit risk, and you start providing in a stage 2 for full-time expected credit losses. And then stage 3 is much more specific. You start seeing this particular customer is suffering difficulties. This particular customer is now not paying his debts on time. They have approached me. So stage 3 is more holistic, and stage 2 is more holistic, and stage 3 becomes very specific to the taxpayer. That you also provide for the lifetime expected losses. Okay, so that's very much an accounting perspective, but what has happened in 11J has been now linked to whatever stage you are for under IFRS 19. And effectively, it says that you can get 40% of your impairment provision if it is under stage 2 and 3. Okay, and 25% if it's under stage 1. Okay, so it sounds to be generous because it's up from about 25%, but you must remember the basis is different. The old 11J, you got 25% of whatever the value of the debt was. So a lot of people would say, I'll take my provision for doubtful debts, maybe it's R1 million. You add it back and you claim 25% of the provision. It was incorrect. You were entitled to 25% of the debt that was considered to be doubtful. For accounting purposes, you may have only provided 50% of the debt. So the debt may have been R2 million. For accounting purposes, you created R1 million of provision. Then we all add back R1 million and claim 250,000 rand. You're entitled to say, but hang on, I add back R1 million. You start looking at from the start, you say, but the full R2 million is doubtful, so I'm getting 25% of 2 million. Okay. Now, under the new 11J that applies to years of assessment commencing on or after 1 January 2019, you only get the 40% or the 25% on the amount of the impairment. If it's not been impaired, you can't. So in this case, if under stage 2 and 3 you've impaired R1 million, you get 40% of R1 million. If under stage 1 you've impaired 25%, you get R1 million, you get 25% of R1 million. Okay. So that is the difference. Now, I'm not going to elaborate on how IFRS 9 gets applied and in certain things, but suffice to say that it's very important that if your client applies IFRS 9, that the stages are correctly categorized so that you can do the tax properly. And if SARS were going to audit it, they will audit whether IFRS 9 has been applied properly. Okay. So, but if IFRS is not applied, now the law says if IFRS is not applied to that debt. Now, if your client applies IFRS to small and medium enterprises, then IFRS is applied to that debt, but IFRS 9 is not applied. Technically, if you purely were to look at it, then you can't get any 11J deduction. But the intention of the law, and if we clarified it with SARS, is that the law should read if IFRS 9 is not applied to that debt. Okay. So if IFRS 9 is not applied to that debt, then the taxpayer gets 40% if that debt is 120 days or more in arrears, or 25% of the debt if it is 60 days or more in arrears. Now, remember, this is not, many taxpayers we'll just say, I'll take my debtors age analysis. Whatever is on the 120 days and over, I claim 40% of that. 60 days and over, I claim 25. That is incorrect, because if your terms are that you pay within 30 days, then it means you can only claim 40% 150 days over. And you can only claim 25% if it is 90 days and over. So it is when it is in arrears. There are practical difficulties because the debtors age analysis is done from the date on which you issue the invoice. That doesn't mean that's the date on which that date becomes due and payable. Okay. If your terms are that it is due and payable on presentation, then you can assume that, but there could also be a difference because I can issue the invoice today and I only get to the debtor in a month's time and I give him the invoice. So then it becomes only once he's received it that he must pay for it. Okay, but be careful that this is, and then again, you only get it from the amount of the provision that you've made. Right, okay. And then as normal, you will just add it back in the next year. So SARS may increase under considerations that percentage up to 85% if it's your stage 2 and 3. Okay, and they will look at the history on that. Okay. VAT and irrecoverable debts, there's a bit of a there is not an alignment between the income tax and the VAT. You get an income tax break even if the debt is only considered to be doubtful. From a VAT perspective, you only get the break when it's considered to be bad. So once you write it off. So what the section talks about is that where you've made a supply, you can get a tax deduction once it has been written off as bad. Okay, so what is written off as bad is SARS is saying that it must be, from accounting purposes, written off. Now, is a IFRS 9 provision an irrecoverable debt? No, it's only a provision. It becomes very difficult to determine when you've actually written it off. Okay. Then the question comes in, what about non-statutory penalties? Okay, so your VAT 409 guide for fixed property and construction says that, so if you are liable to build a house for a person and you did not complete it in time, and there's a penalty, generally that penalty will just be that the person will pay less. They'll keep a bit of the retention. So if there's a retention, you don't pay the VAT until the retention is due and payable. From an income tax perspective, we also argue that the retention is only unconditionally accrued to you once that period has lapsed and that you've complied with it. So generally, they will keep the retention back, or if there's a penalty because you did not complete in the right period, they'll just reduce the turnover. They'll just reduce the value of supply, and you only account for that on the reduced amount. Okay. What about no-show penalties? So one example that Trade Tax Plus has provided us is, for example, a car rental company charges you for a no-show penalty. So in that kind of scenario, because part of the scheme of profit making, it's clearly taxable from income tax perspective. From a VAT perspective, the charge is for making available that car. So you had to keep that car available. You could not just keep that car and rent it out to somebody else. You had to have 10 cars there. Now, if you don't show, you were actually prejudiced because you couldn't rent the car out to another party. So therefore, it attracts that no-show penalties. Okay. This becomes interesting, compensation for damages. So from an income tax perspective, if there is damages because there was an act by one party that committed a breach of contract, you look at the hole that damages needs to fill. So if you receive the income, and the damages that you suffered was a capital damage, then that receipt will be regarded as capital in nature. If it was revenue loss, then that will be a revenue in nature. There are specific sections for grants from government, and some of it are exempt in terms of 12B. If it is, but the same principle applies there. If you receive a grant from government and it's intended to compensate you for salaries, then the salaries are tax deductible when the grant will be taxable. Okay. If it intends to assist you with capital projects, then it will be deemed to be capital in nature. Then you've got to reconsider whether or not there's a specific prohibition on the deductibility of your capital allowances. For VAT, you must check whether you have been compensated in terms of a contract of insurance, if you've been compensated in terms of a contract of insurance, then you are deemed to have made a supply of services and you need to pay output VAT in terms of Section 8 of the VAT Act. If it's not under a contract of insurance, then it's often argued that there's no supply of goods or services, no VAT is payable. So if, for example, there has been a breach of contract and you did not deliver anything and there is a compensation for damages, you may argue that I have not provided any goods or services, and then that amount does not attract output VAT. But every contract needs to be considered its own merits and detailed tax advice, particularly VAT advice, because the cases may be different, and also the nature in which you settle these damages can be different. So you may or may not be liable for output VAT on it. From the perspective of the person who pays it, the same kind of principles will apply. If it's an ordinary course of events, you will generally be able to claim a tax deduction only if it is an inevitable concomitant of the business that you do that you have to pay these damages. So if it's not an inevitable concomitant of the business, then you will not be able to claim an income tax deduction for those damages. Normally, if there's damages that's over this COVID-19 period, one will have to see what is it. It could be operation, it could be capital, but careful consideration is required. Okay. Lastly, we have a look at prepayments, and it's a bit interesting. So Section 23H talks about if you are allowed a deduction 11A, C, D, or W, or 11 cap A, that deduction is limited to the period over which you're going to enjoy the service, or to the period that the goods have actually been delivered. Okay? There are exceptions to that. If you're going to enjoy the full goods or services within 6 months after year end, then you can claim it. So no matter what the amount, if it's 2 million, 3 million, it doesn't matter. If the full enjoyment of the services is to be enjoyed within 6 months, you can claim it. Then everything that is beyond 6 months, you all add it up. If they are all below 100,000 Rand, you can claim it as a tax deduction. If it's over 100,000 Rand, you delay everything. You don't claim the first 100,000 Rand. So let's just look at a case study. So let's assume your financial year end is December 2019. So in December 2019, the company makes a prepayment of 400,000 Rand for an annual conference to be held in April for its distributors. So it's a tax deductible event because it is in the production of revenue. There will be distributor of the year winners and all of those things. Now, because of the COVID, you had to postpone that event in March 2020. You decided to postpone it until October 2020. So now you've got to submit the December 2019 tax return. And clearly, the event's only going to happen in October now. So then the question is, in your December 2019 tax return, can you still claim it? Because it was supposed to happen within 6 months. So let's look at what the Act says. It says where all the goods or services are to be supplied or rendered within 6 months at the end. So the post-balance sheet event, if you had a contractual obligation where it would have been supplied in March, then arguably you should be able to get a tax deduction, because the fact that it was postponed after year end because of an unforeseen matter, it was not because you didn't want to have it in March, it was because of the COVID event. It shouldn't prejudice you in doing your December 2019 tax return, because as at 31 December 2019, the services are to be supplied within 6 months. This is typically one that I would have liked an advanced tax ruling from SARS, a binding private ruling, especially if the number is big, if these events are postponed beyond the 6 months period. If you cancel it and you only get 250,000 Rand back, then there's a recoupment in the next year if you can get the 400,000 Rand as an initial tax deduction. Okay, so that's an interesting case study. Case study 2, let's assume you're a taxpayer and it's a juristic person, but the net asset value and turnover is less than 2 million Rand. So it enjoys protection under the Consumer Protection Act. So this company, it buys a flight ticket for a business trip to London, and it buys the ticket in December for 15,000 Rand. Okay, so now it's a December year end, and normally, so you paid 15,000 Rand for both reasons, it's below 100,000 Rand within 6 months. You would have said, I could get a tax deduction for this. So under your normal 23H, you would have been okay. But hang on, the whole topic of today's discussion was the Consumer Protection Act. Now, this trip will occur more than 25 business days after the days that you have paid for it. So that money is still deemed to be the property of the juristic person. So have you unconditionally incurred a deduction if the money is still yours? So you've not done really a prepayment in terms of Consumer Protection Act. So it's interesting. The whole discussion up to now has been from the perspective of the recipient of the money, where you are covered, but the payer of the money, when they do their tax return, they can also be prejudiced by the Consumer Protection Act, and there may be a delay in the tax deduction. Obviously, we're not looking at around 48 million rand. We're looking at much smaller monies, but you have to consider it from both ends of the spectrum. On Thursday, please join us for Webinar 6. In Webinar 6, we're going to talk about COVID-19 events and how that impacts your larger companies, how it will impact them on a fixed asset management basis. What happens if you've got to close the business temporarily? Can I still get an E? Can I still get a Section 36 if I don't mind? How that applies to the COVID-19 and the debtor management. We're going to talk what's the situation. Again, recap on your doubtful debts, your bad debts. We will have a talk about if you compromise with your debtors, your stock management, what will happen of your stock. It is now worth less than what it used to be worth. There's stock obsolescence, maybe in excess requirements of what you have. We'll talk about this and assess losses, especially the new legislation that will come in. Capital structure management. Companies will require new capital. What will be the impact if you raise new capital, new loans? If you recapitalize and if you capitalize a loan into shares, what will happen if you compromise the debt? And then there could be many companies that will believe this is an appropriate time to do mergers and acquisitions. Let's buy out companies in distress. How are we going to fund that? Is there any prohibitions on the way that we should do it? What are the tax treatments of due diligence costs, of legal costs? And so on Thursday, we'll be talking about these impacts of the COVID-19 on larger businesses. Thank you for your time, and hope you're enjoying the rest of your day. Goodbye.